All right. So good evening and welcome to the second session on IAS 12. This will be IAS 12 video part 2. The very first part, we looked at IAS 12 in terms of financial reporting. Our focus was just on the current tax and a little bit of deferred taxation in terms of your PPE revaluation. But this session is going to look at deferred tax in detail. Very detailed session on deferred tax. So we look at deferred taxation. Deferred taxation. Now, what is deferred taxation about? The word is deferred, meaning that the tax has to be paid and it has been postponed. That is the simple English analysis of deferred taxation. But in terms of accounting, we are looking at it as an accounting adjustment or a measure which we use or is aimed to match some tax effect of transactions to the relevant accounting period. That looks more technical, but I'll break it down for you. So in terms of definition, deferred tax is just an accounting adjustment. As a matter of fact, even in Ghana, our laws doesn't give recognition to deferred tax. So we are looking at it as an accounting adjustment or a measure. And the aim, it's actually aimed at helping us to match the tax effect of transactions, the tax effect of transactions to relevant accounting period. All right, so in terms of analyzing this definition, you realize that it's just an accounting measure, all right, kind of an estimate, okay? And the aim is to actually match the tax effect on transactions. We are matching the tax effect of transaction to their relevant accounting period. Let me give you a typical example. Now, what this whole concept of deferred taxation is trying to look at is that the fact that we have accrual concept and transactions should be recorded as and when they occur, not as and when cash or cash equivalents are exchanged for them. So we all know that basic understanding that whenever you make a profit, you have to tax it. So, for example, look at this example, and that is what we did in the first part of the video. So look at you having a PPE, and you have the carrying amount of the PPE to be, let's say, 10,000. Carrying amount meaning that you had cost, you have deducted all your depreciation, and that's your carrying. Now, if you revalue this carrying amount, you have revalued it, and it is to say 15,000. What happens to the difference, which I know you know is 5,000, and it is going toward the OCI? I've already told you that the purposes of the OCI is to record unrealized gains. It's a gain, but you have not actually realized it. I mean, come on, you just use some expert to revalue your PP and something that is 10,000. You are not telling us that it is in your book as a 15,000, and therefore you could see that there is this 5,000, which is called a revaluation surplus. Now, if it is a revaluation surplus, then what it means is that it's a surplus and therefore it's a gain. And since it's a gain, we have to tax it. Now, we need to tax this figure. However, it is not a realized figure, but we still have to tax it because if in the future, okay, if in the future, let's say in 2 years' time, you go ahead to sell this asset, you sell it for, let's say, maybe let's say you sell it for 20,000. Okay, you sell it for 20,000. Maybe 2 years time, and let's say the depreciation that had to occur after you have revalued this was, let's assume 2 years depreciation for that to be 5,000. Which means that as at the time we are selling it, the value of this figure will be what? 10,000, right? Which is the 15,000 minus the accumulated depreciation, which is 10,000. And we have sold it for 20,000. And this tells us that we have made a gain of what? 10,000. So that is that. And this one, since the asset was sold, this part become realized. So that is that. But you see, the accountant doesn't want to wait till the asset is sold before this whole tax issue moves out. And so therefore, immediately there is this adjustment called deferred taxation, okay, that they will do. Now, they are going to do this deferred taxation by finding what we call a temporary difference. And we are going, when we talk about the temporary difference, we are looking at the taxman perspective of the carrying amount of our asset, the taxman's perspective. Because why? When we are using depreciation, the taxman doesn't use depreciation. The taxman uses what we call capital allowance. And so he will do the same analysis on our PPE, but he will be using what we call capital allowance. So where we are doing depreciation, he is doing capital allowance. Okay, so and that thing is what we call temporary difference, because what he is doing will bring about a difference in comparison to what we do because our depreciation figure has changed. And so you look at these adjustments, you look at the taxman's perspective, and you find the difference. Okay, and that difference is what we call temporary difference. There are two types of differences in when it comes to deferred tax analysis. We have the differences, we have permanent difference and we have temporary difference. Permanent difference and we have temporary difference. You know, permanent difference is a difference that is permanent, i.e., look at your profit or loss. You have put in some expenses to the taxman, they are disallowed for tax purposes, but there is no replacement. They are just disallowed forever. They won't give you anything in place of that. Okay, so that is that. But there is another one called temporary difference. The temporary difference, they will give you something in place of that. So whilst they are disallowing your depreciation, they are giving you what? Capital allowance. So that is that. And our focus on deferred tax is on the temporary difference. Okay, our focus is on the temporary difference. So deferred tax computation, if we want to calculate a deferred tax, what we're going to do is to use the formula. So deferred tax, we do deferred tax is equal to the tax rate we need. We need our tax rate because it is tax and therefore we need our tax rate. Then we will multiply that tax rate by the temporary difference, TD. Temporary difference. All right. Now, we need to understand the temporary difference. And like I already explained to you, you realize that what goes into the calculation of what we have, our asset and our liability, is what we are looking at. So deferred taxation is actually the excess of one. We are looking at the carrying amount of our assets or liability, the carrying amount, minus, so the excess of the carrying amount and the tax base, the taxman perspective, the tax base. So a tax base is actually the amount that is attributable to an asset or a liability for tax purposes. For tax purposes. So whilst we are looking at carrying amount, the taxman is looking at what? A tax base. So the difference in that, it's what would generate to us a temporary difference. And when we get that temporary difference, then we multiply our tax rate by it. All right, so basically, that's that. Let me give you some notes, something that you need to consider. You need to be careful of when it comes to the tax base. So let me give you some two important notes on tax base. The tax base. Now, what you need to understand, we've talked about the tax base of an asset, the tax base of a liability. What is that? So we look at the tax base of an asset. What is a tax base of an asset? All right, so the tax base of an asset, we are looking at the taxable value that provides economic benefit to the entity, the taxable value. The taxable value. That actually provides economic benefit to the entity. So if you know your capital allowance very well, you realize that the tax base of an asset is, so you will need the cost of it. And what do? You less capital allowance. And you get what we call what? WD. So this WD, the written down value, okay, is what is generating economic benefit to the entity. So basically that is that. Now, one thing you should understand, therefore, is that if the economic benefit will not be taxable, then it means that the carrying amount of an asset is equal to the tax base. All right. If the economic benefit will not be taxable, then it means it suffices that the carrying amount of the asset is actually equal to the tax base. That is that. But if the carrying amount exceeds the tax base, then it means you have a temporary difference, and that one will give us what we call a deferred tax liability. And conversely, if the carrying amount is less than the tax base, then that is going to give us a deferred tax asset. So that is something you need to understand. All right. So if you have, there is therefore a deferred tax liability. If the carrying amount is greater than the tax base. Right, the tax base. And therefore, when it happens like that, the deferred tax will go to your NCA. All right. So that is that. But there is a deferred tax asset when your carrying amount is actually less than the tax base. And that is your NCA, so deferred tax asset. There is therefore no tax if CA is equal to the tax base. So that is what you need to understand. All right. Then we look also at the tax base of a liability. Tax base of a liability. What is the tax base of a liability? The tax base of a liability. All right. So a tax base of a liability is also the carrying amount of the liability minus any amount that is deductible for tax purposes in future. Okay. So you have, it will be the carrying amount of the liability. For example, when we do leases, you realize that you do your balance brought down, finance cost, payment, then the balance carried down. That's the carrying amount of that lease liability. All right. So the carrying amount of the liability. Then you are going to less what we call amount, or any amount deductible for tax purposes. If there is no amount deductible for tax purposes, it is zero. So always check the question, deduct for tax purposes in future. Always check the question if there is any amount that is allowed for deduction for tax purposes. So if there is no amount, then it means that the carrying amount will stand as the tax base of a liability. So that is what you need. That is what you need. So that is the tax base of a liability. Okay. Now there is something you need to note, and it has come up in one or two questions that you see, if in the liability part there are monies that are received in advance. So let's say if revenues, or let's say rental payments, since I use leased, all right, revenue or rental payment are received in advance, then the temporary difference, or sorry, the tax base rather of the liability will therefore be equal to what? The carrying amount of the liability. All right, less revenue not taxable in future. All right, less any revenue or payment, since I've used lease as an example, or payments, I mean the rental payments. Okay, the rental payment not taxable in future. These are serious notes you need to be mindful of, because I have seen it examined in questions. Very, very serious. And these are, when it comes to deferred taxation, these are places most of us tutors really don't touch on, but I'm taking the time to actually deal with this one for all. All right, so that is that. That is that. So I'm going to give you some examples of this tax basis, all right, so that when you encounter them in your exams, you are already familiar with it and you are good to go. Okay. All right. So that is that. So let's look at some examples of these tax bases. All right. Okay. Now, the first one that I'm going to give you is what you already know, right? Now, we call it using the NCA part, non-current asset PPE. You realize that how to get the tax base will be the carrying amount or the revalued amount, all right, versus the written down value, the WDV, from the taxman. So the WDV, where you are doing cost minus accumulated depreciation and depreciation, the tax man is doing what? Cost minus capital allowance over there. All right, so that is that. That is that. Another one is pension liability. Pension liability. You and I do know that even in Ghana here, there are some tier 2, tier 3 things that you do that when you contribute and you withdraw the money later in future, you'll be taxed. So you see, the taxman perspective of deferred tax is that he doesn't want you to wait and that in future when you withdraw and they are taxing you, he wants to do the accrual concept of that tax that will be taken from your money in future now. Right? That is the accrual concept, and that is what we call deferred taxation, the accounting adjustment, so that they can relate the tax effect of that transaction you do in that future to the relevant accounting period. Yes, because the moment you start doing the savings, you are supposed to actually be paying the tax from now. It's just that you have deferred the withdrawal of the money to, like, say, 5 years' time. And so the tax will be done in 5 years' time. But like I said, it's a accrual concept. You don't wait till the cash is exchanged and you actually do deferred tax for each year. So that is why you do deferred tax movement into your P&L every year. So it's just like the IFRS 2, remeasurement component year on year. As you move towards the year that you are doing the withdrawal for which the tax will be done, the taxman will be doing a deferred tax movement, small into P&L, deferred tax movement, P&L. And that is what you learned in the first video. So the deferred tax movement in DT, that is the one that is recorded in the P&L. All right. So when it comes to pension liability, you realize that you accrue the liability, right? Yeah. So since you have accrued the liability, you also have to go with the tax effect. So we know that pension liability is accrued in the financial statement, but allowed for tax upon withdrawal, right? Upon withdrawal. Yes. So we won't upon withdrawal in future dates. So we, the accountant, don't want to wait so that when you take the money, then the massive tax that has come upon you will enter into 1 year financial statement. No. But you know that you will always be paying the tax in future. But accounting is accrual. So what we are saying is that the amount of money that you have put into the pension fund this year is actually subjected to tax. But you and I know that it won't be taxed till you withdraw the money. So why don't we start apportioning the various tax effects of the money that you withdraw in future now? So that by the time you get to in future, every year prior to the time you did the withdrawal has already a P&L item of tax, that is the movement in deferred tax year on year, into your P&L account, so you don't suffer anymore. So these are the issues. These are the tax-based issues. All right, these are the issues. Okay, then another example. So I told you about the PPE, the revaluation surplus thing, and we don't want you to wait till you sell the asset before the tax is. So I'm going to go over that one again. So, and that is the one that I'm bringing up now. So upward revaluation. Upward revaluation. So this one is facing this, and we are talking about upward revaluation. When there is an upward revaluation, you realize that there is a gain on it, but what you also know is that no adjustment of tax is made till the asset is sold. That is why we rather do those deferred tax. All right. Yeah. So that is why we actually make the deferred tax issues in there. All right. Another one is what you know in your consolidated financial statement, which you call provision for unrealized profit. All right. You see, the thing is unrealized, but yet it's taxable in the computation of your group profit. It's taxable. So though it is unrealized, it's still a profit, and it will be realized sometimes to come, particularly when whoever has those inventory is going to sell it to a third party, not the people in the group. So if he's going to sell it to a third party, then you realize that it will be realized. So even though now it is not realized, we actually have to do the deferred taxation effect on that. Okay, so that once it is realized, we have actually placed the P&L items in the respective years before the thing has been sold. Okay, so that you see, like the pension one, you don't wait until you now you see that they charge you a huge tax, and that is going to enter 1 year P&L. But you and I know that that money that is in there is accumulated from several years to that point. So why will it go, all of them go into the year you did the withdrawals P&L? It doesn't really match it very well. All right. So that is the same thing here. So the unrealized profit is unrealized yet taxable. Yet taxable in computation of group. So is the group, not the individual. All right. That made the unrealized profit. That made the part. All right. So that is to that effect. All right. That is to that effect. All right. So that is that. Another one, which is also unpopular, is what we call the development expenses. So this should be number 5. Development expenses, IAS 38. Development expenses. All right. Now, development expenses are capitalized, then later amortized into the P&L, all right, for future period. But you have to understand that those ones too are deductible expenses. So you see, instead of bringing the thing into expenses, you don't. You wait till it is accumulated into the product is, has passed the pirate test before you start the amortization. So you see, you bring it into the P&L in future periods. So there is this postponement of an expense that would have been deducted from your profit. Then you do the tax report, but you didn't do it. You actually deferred it to pirate. The recognition criteria of development expenses were met before you amortize it back into the P&L. So something that was, you expense the money this year, but you didn't bring it into the P&L this year. For you to reduce your gross profit and for you to get profit before tax, then tax. You didn't bring it in. You actually deferred it till it became a development expense. Pirate is met. So you see, you have actually deferred an expense that was deductible. So is also a deferred taxation effect. It also comes about that. And in terms of determining tax, these are what brings about the differences in tax base. So because to the taxman, he might have said it's an expense. Please let me use it, calculate the tax. But you have deferred it and you want to wait to a point where you amortize it back. So there will be these differences about how you are treating the expense and how the taxman is also treating the expense. The taxman say now you are using IAS 38. Okay, so these are the issues. So you realize that it is capitalized and amortized in future in the P&L of future periods, but not the timing the expenses actually okay. So that is what happens. But even though it is future, we all know that these expenses were deductible expenses. So you accountant is waiting as it is amortized, capitalized later, and amortized back to P&L. But the taxman is saying that it's now is deductible expense. So it gives rise to temporary difference and issues of tax base has to come in. So these are examples of actually these differences that happens. All right. So let's look at the SIT one, which is also very crucial. We look at employee benefit. Employee benefit. All right. Our focus here will be share-based payment. Share-based payment. Instead of paying money to the employee, you are using a share options. So a share-based payment. Now, share options are recognized in the P&L, but no tax deduction is obtained till the share is actually exercised. So if you know your IFRS 2 very well, you realize that you recognize some of the parts in when you are doing the movement, you bring it into the P&L. I mean, you did a provision this year. There's another provision next year. The differences in this provision will come to the P&L. All right. So you realize that the options are actually the share options are recognized in P&L. You see the movement in P&L from your IFRS 2, but no tax deduction is obtained. Why? Because whatever you do is a provision and the taxman doesn't really go well with your provisions at all. And like the provision for the unrealized profit, it doesn't go well with him at all. He doesn't use provision because if he starts adapting and accepting provisions, people will actually use provisions to dupe the tax laws. So he will not give it to you as a tax deduction. He won't. But you, as an accountant, when you're preparing your account, it went in there and it affected your profit. So for the taxman, no. So you will see that for the taxman, it is when the option is actually exercised. All right. When the option is actually exercised. So you won't get any tax deductibility for it. All right. Until the share is exercised. Until shares are exercised. So these are what brings about the temporary differences. All right. So that is that. That is that. All right. Now, what we're going to do next is to talk about the recognition. I mean, how do you recognize deferred taxation? So let's deal with recognition. How do we recognize deferred? We will very soon look at some computations. How do you recognize the deferred tax? So deferred tax, actually, we have already learned, should be provided on all temporary differences. So all these examples of temporary differences that I've given you, all these ones, you have to provide for deferred tax. So it should be, deferred tax should be provided for all temporary differences. So far as there's a temporary difference, deferred tax should be provided. Unless, and that is the caveat, and learn this very well, unless it is goodwill, all right? So for goodwill, we talk about goodwill for which amortization is not tax deductible. So deferred tax has no issue with goodwill. All right. So that is that. That is that. Okay. Again, if you have any initial recognition of any item that affect neither the accounting profit nor your tax profit. So you see, everything we are doing that is bringing about temporary differences because certain things affect the accounting profit and the taxman also sees it differently. So if you have any item whose recognition doesn't affect those sites, all right, initial recognition of items that affect neither the accounting profit and the tax profit. So those ones too don't bring any issue of deferred tax. All right. If you have insufficiency of taxable profit to be available in the future, against which your temporary difference can be utilized, that one to so if you have let's say in future there should be deferred tax, but you have some kind of what do we call it, carry over losses to actually offset it with it, then that one too there is no deferred tax issues. So let's call it insufficient taxable profit. If I don't have taxable profit, I mean, how can you even talk about tax? All right. And these insufficient taxable profit, let's say credit losses, are expected to be available for me. So unused credit loss, unused tax loss. Yeah, tax loss. Let me call it like that. Tax loss. Or what we call carryover losses. All right, which will be available in the future against any taxable differences, any temporary differences, TD. All right, so that one too saves you for that. Okay. And key thing is that, you see, we have been talking about deferred. And most of the time in accounting, every deferred income is PV. But when it comes to deferred tax, please ensure that you keep this in mind. Deferred tax, whether asset or liability, are not discounted. And that is why we do the movement in the, they are not discounted too. So take note of this caveat. All right. So that is that. That is that. We have learned the revaluation aspect, when the revaluation happens, how you are going to do the temporary difference sort of, and you take what will go to P&L to P&L and what will go to OCI to OCI. So I'm not going to spend any much time on that. So I'm actually going to move on to the ones that are not familiar to you. So the one that I will look at now is share options. Share options. I've already pointed to the fact that it gives rise to deferred tax because there will be a temporary difference. So what you see is that remuneration is actually an expense and it should be recognized in the P&L over those vesting periods. Okay, so you have a vesting period, you do provisions for the number of people who will vest, then the differences are always going to the P&L. All right. So what you see is that, number one, what you should understand is that it's a remuneration. You are paying them something. It's a remuneration and it's an expense. All right. Which should actually go to your SPL, the statement of profit and loss. All right. Profit or loss for the vesting period. And that is what you do in IFRS 2. All right. Now, what you realize is that there is no tax deductibility for those things because the person has not actually exercised their shares yet. Okay. And so it's a provision that is going into your P&L and nobody allows those things. So what you see is that you don't get any tax relief for that. Tax relief is not granted. It's not given to you as a tax deductible expense. All right. So it's not granted. And I've already explained to you why. Because so the thing is exercised, it is a provision in your P&L. All right. So it is exercised. Exercise. All right. So that is it. That is it. If you know your IFRS too well, you realize that you always determine the number of people who are expected to vest. So you do that. It's a provision item in your current non-current liability. So the differences that is happening year on year actually sits in your P&L. All right. So, and because it's a provisional expense, nobody will give you any tax relief for that. It will not be allowed for tax purposes. All right. Yeah. But the day the thing is exercised, that you get a tax relief. So how do you determine the amount of tax relief? So the amount of tax relief, the amount of tax relief that will be granted is based on the intrinsic value of the share. Intrinsic value. And since you have done IFRS 2, you know what an intrinsic value is. All right. Yeah, it's the intrinsic value of the share. You know, the value of a share of these shares, options, is a combination of the fair value and time value of money. All right. So the intrinsic value of a share is actually the fair value of the share. So the market price. All right. The full market price. That's at the market. The fair value at the market. All right. Minus the exercise price. So you see, I always tell you that if you are given the opportunity to exercise or buy a share at 5 cedis, and as at the time your exercise date the value of shares in the actual market is 10 cedis. Everybody will exercise, because once he exercises, you know that then in the market is 10 cedis, but you have given him the opportunity to buy it at 5. Why won't he take it? He will take it and he will actually go and sell it in the market and get ×2 of the value. Okay, so that is that. That is that. That is that. Now you will see that this relief that the person is supposed to get is actually delayed until the exercise. All right, it's delayed. It's delayed. So what you see is that there is a delayance. So you get a delayed tax relief. All right. That is what has happened. That is what has happened. So you will see that in conclusion, you will say that whenever there is equity-based, equity-settled share-based payment, there is deferred tax. There is deferred tax, as you can see for the analysis. So therefore, the deferred tax, which is DT, will therefore be you calculated using the tax rate multiplied by the carrying amount of the share-based payment minus the tax base. The tax base of the share-based payment. The tax base of the share-based payment is actually the intrinsic value. All right, the expected future tax relief. Based on the intrinsic value. Based on it. All right, that you are accruing till the share is exercised. All right, so you realize that a deferred tax must be recognized. Deferred tax must be recognized. It's very, very important you understand this bit of it, because very soon we are going to look at how the figures look like. So if the estimated future deduction, which is tax, is greater than the accumulated remuneration of expenses, then it means that the tax deduction relates to partly to the expense and partly to the equity. So let me give you that caveat. So you realize that if the future estimated deduction, I mean the tax part, is actually greater than those expenses that you have accumulated. So the thing was exercised. Then it means that will mean that the tax deduction will relate part to the expenses and also part to the equity, because it's an equity-based share-based payment. All right, and so therefore you have to recognize the deferred tax as such. All right, so that is that. We will look at the figures soon. All right, we will very soon look at the figures. All right, so these are things that you need to put into mind. Of course, the second part I can show you is the business combination. Let me add that one quickly. Then let's look at some figures very soon. So apart from the share options, it can even happen to your lease. Can even happen to your lease. But you see, so when we pick up the computation, you realize that, because what you see is that in the lease, like we've spoken about before, when we started looking at the tax base of a liability, it can happen in the perspective of a lease, because lease rentals that you pay, so the carrying amount of your liability, you take off any amount that is given to you as tax deduction, you will have a value equal to your tax base. Your tax base, and that is the one that you are going to compare to the carrying amount after you have gotten your right of use and you have depreciated it. That is the one that you are going to use to do your comparison and get any temporary difference for tax purposes. So basically, that is that. So let's look at shortly the ones that comes out of business combination. The provision for unrealized profit, the PAPs. All right. So PAPs in consolidation, you see the carrying amount of your inventory is reduced, but the tax base remains the cost in the individual's financial statement of the purchasing company. That is what happens. So that thing will create a temporary difference, and that will give rise to the deferred tax. So you realize that in the consolidated financial statement, the inventory, all right, the carrying amount of the inventory is reduced, because when you do your PAP, you deduct it from your inventory, don't you? So CA of inventory is reduced in the consolidated financial statement. But the tax base remain at cost in the individual financial statement. Yes, that is what happened. The tax base is still at cost in the individual financial statement, especially the one who purchased it, of the purchasing entity, because he purchases at cost. That is what happens. And that scenario, this whole scenario is going to give rise to a temporary difference. Because whilst it is reduced here, it's at cost here. And so because there is a temporary difference, remember, recognition of deferred tax, everything that gives rise to the temporary difference must be subjected to deferred tax. So that is that. So PAP is removed from the consolidated financial statement. So the tax charge in the profit should also be removed. That is that. That is that. All right. Again, another one in business combination is the fair value adjustment that we do. Fair value adjustment. So the fair value adjustment is normally when the fair value is greater than the carrying amount, and that gives rise, has a tax implication. It has a tax implication, and it is subjected to deferred tax. So you will see some of the consolidation questions that will tell you that the deferred tax, the fair value adjustment that you do is actually subjected to deferred tax. It is recognized. I don't know if you have come across a question like that, but it does happen. All right. So the deferred tax on the difference is treated as part of the fair value of the net asset. So in that case, the DT, okay, on the difference, that difference you always treat as fair value adjustment. All right. There is deferred tax on that. That is treated as part of the fair value of net asset at acquisition. And please, those of you who have watched my consolidation video, I always tell you that the fair value of the net asset, that net asset, understand, is asset minus liability. So if there was any deferred tax, which is also a liability, you have not considered, you are now considering it. So it will be part of your fair value of net asset at acquisition. And if it does affect that, which is your workings 2, definitely it will also affect your workings 3, which is your goodwill computation. So take note of that. Take note of that. But you see, goodwill in itself does not give rise to deferred tax. Remember that. Remember that. So these are issues that you. So if you have a consolidation question that asks you to talk about, also bring into the scenario deferred tax, find out, is it a deferred tax asset? If it's a deferred tax asset, you add it. If it is a deferred tax liability, you deduct it at acquisition. At acquisition. Please take note of that. All right. So that is that. Now, what we need to do is to actually look at some figures, how we can apply these things in questions. So let me actually pull up some questions. Then let's deal with it. Okay. So let's look at this question. All right. So let's look at this. So we have the directors of panel, and it's a public limited liability company who have these issues about IAS 12 that they want us to help them understand, maybe appreciate what to do. Okay, so the first one that we have is here. So on November 2013, they granted 10 million share options with 40 million, subject to a vesting period of 2 years. So I understand that it's for 2 years. The local tax laws allows a tax deduction at the exercise date of the intrinsic value of the option. The intrinsic value of 10 million shares as at October 2014 was 16 million, and as at October 2015 is 46. The increase in the share price in October, in the year to October 31st, 2015, could not be foreseen in 2014. The options were exercised in 2015. So the date that the option is exercised, then it means it is exercised. There is nothing like a future tax. It is exercised. All right. So the directors are unsure how to treat this transaction. So it is our job to help them. It is our job to help them. Now, first of all, per what we've learned, we've learned that anytime there's a share-based payment, there is a recognition of expense, given that the thing is vesting in 2 years. So you have to estimate year 1, but in year 2, you don't estimate anymore. You actually get the real thing because the vesting date is in year 2. All right. So, and we also know that the intrinsic value is the focus of our tax base. All right. So, that is it. The difference between the intrinsic value of the option and their carrying amount, which of course these carrying amounts are normally 0, of share options. Yeah, that is what will give us the tax base for us to actually do our deferred tax on it. You see, because the thing has to be done, we have to wait till it is exercised. That is why it gives rise to deferred taxation. So now, at 31st October is 10, right? 2014, we have issues of deferred tax we need to deal with. I think good news is that the intrinsic value has been given, which is 16 million. It has been given to us. So there are two ways you can go around it. You can actually do it is for 2 years, and so you can actually, because it is vesting in 2 years time, so which is 2015, so 2014, 2015. So you can actually split this 16 million into two, or you can actually go ahead and do your deferred tax and understand that the deferred tax to be recognized in each year 2014, particularly in 2014 financial statement, will be the part for 2014. All right, so it's either you say the 16, which gives us 8. Of course, this is our tax base. All right, that is our tax base. But the carrying amount usually is 0. The carrying amount usually is 0. So if you have the intrinsic value, which is your tax base, so the tax base, and CA is 0, what you get here is -8. All right, so then you do your DT, which we are told somewhere in this full question that the tax base for the entity is 30%. So the tax rate, so deferred tax will just be by 8. So which will give us punch calculator. That gives me 2.4 million. You can as well use the 16 and do the 30% and then divide by 2 because 2 years. All right, so that is the deferred tax that we have here. How much expense have they been putting in their P&L? How much expense have they been putting there? In their P&L, we are told that they are granted 40 million. It's for 2 years. So you realize that 40 million, I mean, for 2 years, which means that the thing is worth is worth so 40 million. So in this case, like 40, and you split it, you see that they are recognizing between the 2 years is for 40. So given the number of people who stay for vesting, you can see how much will be going into your P&L. All right. So now what happens in 2015? So like I said, you can actually do 30% of the 16, which will give you, I think, 4.8, and you have your 2 years. Now, as at 31st, 2015, actually, if you were to go by the DT concept, you realize that it will be 30 by 46, right? Yeah. 30, the tax base is 46. Carrying amount is always 0. So you have 0.30 by 46, which actually gives you something like 13.8. However, at this date, it is exercised. And since it is exercised, there is no deferred tax issue again. All right, there's no longer deferred tax issue. All right, so you take note of that. So basically, that is all you do for this kind. Then we have the second one that says that panel is leasing a plant over 5-year period. The right of use was recorded at the present value of the lease payment is 12 million at the inception, which was November 2014. The right of use is supposed to be depreciated over the 5-year period. The annual lease payment is 3 million payable in arrears. As at October, effective rate is this. The directors have not leased an asset before and are unsure about the deferred tax consequences. So the company can claim, so if the company can claim tax deduction for annual lease rental payment. So he said that the company can claim tax deduction for annual rental payment as the lease does not qualify for a tax relief. Of course, this has been an issue even in Ghana law. Should the lease be qualifying for tax purposes? You know, they said that the assets should be owned by the entity by the end of the basis period. So it's still an issue. So now it's a lease plan. So II, the lease plan. So we need our right of use. And also the lease liability. All right. Now, the right of use, we are told that the value is 12 million. So let's just put some kind of zeros. Let's say 12,000. That is all we have for the right of use. And so we are told that it will be depreciated for 5 years. So if you do 12,000 over 5 years, that gives us like 2,400. And so the carrying amount of our asset is 9,600. That's the carrying amount. All right. Then we come to the liability. We do know well that the liability, as is seen, is also 12,000, because that is the future payment. And you know how to do your amortization table. So you have your balance brought down. It is in arrears. So finance cost, then payment, which is allowed, all right, for tax purposes. Then you have your balance carried down. So now, what you have here is 12,000. Then you do your finance cost. The finance cost, we are told, is 8%. So 8% of this thing will give us 9,960. All right. So 0.08 by 12,000 gives me 960. All right. So that is that. And we are told that they make payment of 3 million. So that is 3. And it is allowed. We are deducting it because it's allowed for tax purposes. So that gives us 9,960 over here. All right. Okay. So that is that. Now the tax base of a liability. What is the tax base of the liability? It is 0. We don't have a tax base for. So if they have asked us that there is an amount they want us to deduct out of this, apart from this 3,000 that is allowed, then we would have deducted that. All right. Any amount. All right. So you realize that here you have this 9,000 versus this 9,600. So what will happen is that you have a temporary difference. So your temporary difference herein is your CA, which is 9,600, versus what? Your tax base. Okay. Any other deductibility for tax you don't have. So you have only 9,960. That's your tax base. All right. So temporary difference to the liability, the carrying amount, the tax base of a liability. So you don't forget, this is also a liability. All right. Yeah. The carrying amount is out of a liability anyway. So of the liability is 9,960. All right. So that is that. So what do you get out of here? 96,600 minus 9,960. That gives me a negative 360. And if I have my temporary difference, and do my deferred tax, which is in this case 30% multiplied by a negative 360. Don't forget it's in so let's put it. So what I get is 106,000. And this is a DT asset, deferred tax asset, because it's a negative. So that is that. That is that. Now we move on to the third one, the intragroup sale, which we've talked about. We've been talking about this. So the intragroup, which is the PAP. Don't forget that I said earlier that when you are doing this deferred tax and there is a advance payment, you treat it separately. Initially, when we spoke, it's part in our initial principle. So when we started so this one was a lease that is arrears. That is why you see it like that. So guys, just be careful. All right, be careful. Don't flow with the flow. Know your principle. Know your principle. Yeah, like this. If rental payments are received in advance, then the tax liability is the CA less any revenue. That's the payment that you receive. All right. Okay. Any revenue that is not payment or that is not taxable in future. So there are instances where you have to be very careful when there is money received in advance. So this one is what we just did. The carrying amount of the liability is any amount. So you get the carrying amount of the liability, which was our closing figure, minus any amount deductible for tax purposes in future. All right. So the carrying amount we didn't have any other amount. The 3 million was part of what we used to arrive at our carrying amount. So please take note of that. And take note of instances where there are advance payments. So advance are treated differently. I think we will get a chance to look at an example of an advance. So let's look at the, what do we call it? The intragroup transaction. Intragroup transaction. So we are told that a wholly owned subsidiary, which is Payne's Limited Liability, so they sold goods costing 7 million to Panel, and the goods had not been sold, so it hasn't been sold at the end of the year. Panel had paid 9 million, and what you are told is that the directors do not understand how this transaction will be dealt with in the financial statement of the subsidiary and the group. All right, for tax purposes, things pay a tax of 30%. So what you see is that as far as PIN is concerned, PIN sold the goods, which is costing 7 million, but he received 9 million. So as far as PIN is concerned, PIN is receiving 9 million for something he sold at 7 million. So it means that there is a profit. He has gotten a profit of what? 2 million. 2 million. And tax is payable on this profit in his individual account. In the individual account, he has received the money already. So he has realized the tax. So tax is paid. Take note of that. Take note of that. And that tax is what? 30% of that profit. 30% of 2 million is 600K. All right. So that is that. So for him, in his financial statement, that is how it will be. But let's look at how it is in the group financial statement. So in the group financial statement, the profit will not be realized because the person has not even sold the goods yet. So, but I mean, maybe they will realize it when they sell it to a third party, not people inside the group. Okay, so that is that. But so because the group pays tax before the profit is realized, there's a temporary difference. There's also a temporary difference. So that is that. So the temporary difference is still the 2 million. So TD is 2 million. And if there is TD of 2 million, the group is going to have a deferred tax asset, which is, so which is the 30%, because the group panel also paid 30%. 30% of the 2 million, which is a deferred tax asset of 600K. Well, as you see, if the tax part is combined and this one too is combined, you see that it will zero itself off. That is what will happen. It will zero itself off. All right. So that is that. That is that. Okay. So these are issues you need to get yourself acquainted with. Very, very important. Now let's look at this last part. The last part says that nil, a limited liability company is wholly owned by a subsidiary of panel, and it's a cash generating unit. Whenever you hear cash generating unit, standard like impairment to pop up. All right. All right. The value of the property PPE as at October is 6 million, and the purchase goodwill was 1 million. Okay. Before any impairment loss. The company had no other asset, an impairment of 1.8. Okay, so it says there's a CJU and there is also impairment loss of 1.8. That should tell you something. Should tell you something about sharing impairment loss among CJU. All right. So that's the impairment for the year end. All right. That's the impairment for the year end. And therefore, the tax base of the PPE was 4 million. Okay, thank you guys for giving us a tax base. It means that we should find the carrying amount of the PPE. That's all. Then the director should know how the impairment loss will affect. Okay, so first of all, there is an impairment loss of 1.8 million. And we have two assets. We have PPE. Remember, these things are shared. How do you share it? Per IAS 36, how do you share it? 1, to the specific asset, which is condemned to Grebu. 2, to what? Purchase goodwill. And 3, to other assets on pro rata basis. So if we have 1.8, then let's say we had goodwill. We also have PPE. Okay, so and the carrying amount of these, we have 1 million, and we have this one is 6 million. So when we share the loss, share of impairment loss, goodwill comes first. So we need to write off the goodwill, then the remaining 0.8. This is what happens to us. So let's say here will be what? 7 million. And we have 1.8 like total. Okay. So this is 0. This one gives us 5.2 million. That is what happens. All right. So they said they wanted to know the effect of. So what the effect has done is that it has reduced our PPE to 5.2 as the carrying amount. And we have tax base of how much? 4 million. And so what is going to happen is that we have 1.2 as our temporary difference, of which their tax rate is 30%. So of that 1.2, which is going to give us a deferred tax liability, DT liability of, that is 240,000, right? But without the impairment, what would have happened? We had our PPU to be how much? 6 million, right? It would have been 6 million. When we take our 4 million, we get 2 million. And hold on. So 0.3 by 1.2 is actually 0.36 million, which is 360. But if we had been here and we had 1030 over 2.0, 0.3 by 2, that was actually 0.6. So a 0.6 impairment has not, deferred tax liability has now been reduced to this. So that is going to be how much? Okay, so that is actually minus 0.36. That's actually 0.24 million, which is 240. So the effect of the impairment loss is that it has actually reduced the deferred tax liability. All right, so that is that. That is basically that. All right. So these are some examples of what you should actually get yourself acquainted with. But always be careful when you have instances where there is advance payment on the lease type of example. All right, so be careful about those ones. If there are such instances, then it means that you are going to treat the advance payments alone. Okay, you are going to treat the advance payment alone as the deferred tax standing on it. Let's pick one last example, then we look at it. All right, so we have this example. So Buhai is, so we've dealt with all these ones, right? This one doesn't really give us. All right, let's look at this particular one. So ZTech is a cool one for us to do. Let's look at ZTech. So we are told that he has a 5-year lease for a software, and what we are told is that the present value of the lease payment is 15 million, and the lease rentals are paid in advance. They are paid in advance, and 4 million has already been paid. So these are typical examples of those ones that I was referring to. And in their tax jurisdiction, their tax rate is 20%. So that is what they tell us. All right. So this one means that our right of use asset, for example, is going to be the 15, which is the PV of the lease payment, plus the payment they've made at inception. That makes it 19 million. But be careful, because there is an advance payment in here. It sorts out the liability in such a way that we need to treat them as if they are different. I mean, that is the issue. That is the issue surrounding this advance payment. So you also know that your lease liability is remaining. You have what? 15 million. That tells you that the entire thing was like 19 and they paid for already. So if you are giving the useful life of the asset, you go ahead and deduct to get your carrying amount. Then these are advance payments. And so the trick here is that as you have advance payment, what you need to do is to treat the advance payment separately. You have to treat the advance payment separately. So the deferred tax will be recognized for the advance payment. All right. So how do we go about it? Let's look at how. So in a normal circumstance, what you would have to do is to do your balance, BD, finance. This is advance, so there's payment. Then you get your subtotal. That's what you would have done. Subtotal. Then you get finance cost, then your balance carry down. I don't think we were even giving finance cost in this question. So that alone shows you how you have to deal with certain things when it has to do with an advance payment. So what is going to happen is that with this type of questioning where these advance payments are, it tells you that your balance carry down is still the 15 that you have. Yeah, that is what it tells you. That is what it tells you. So what you are going to do, so if you were to do this, you know you have 19, they paid 5 at 4. They actually paid 4. Your subtotal is, you don't have anything for finance cost yet. So you should be having this. That is what will happen. And if that it has happened, we are not also giving depreciation, but you can also assume a depreciation of 5 years and actually go about, because the useful life of the lease is 5 years. All right, and go around it. Now, that case, you realize that you have to separate this 4 and the 15, because you have that for the 15 already. And the tax rate for these people is 20%. So what you will do is you get a deferred tax asset, because you are not given an amount that should be allowed to be deducted from the liability. So you always have, like, so in this case it's 20% by your 15. That is what you have. 20% by your 15. And that should give you like what, 3 million. Right? Because 10% would have 0.2 by 15. And please understand that it's a DTA, deferred tax asset. All right. So what are you going to do? It's a deferred tax asset and you have a liability. So DTA 3 million, deferred tax liability 3 million. Now the 4 parts, the 4 million. So what do you do? Basically, you are actually not giving depreciation. So let's say the thing is still 90 million. Like we used to do, you will do the carrying amount. If you are giving depreciation, you can assume the depreciation for the lease is 5 years and actually do your 5 years. So you have 19 million, and this thing, your liability tax base is still 15, right? So you have 4. It's basically the same, and you will do 20% of the 4. If you do 20% of the 4, this side is bigger than this, so you have a deferred tax liability of 20% of 4.2 by 4, which gives me 0.8. So you have that of 0. So that is why I'm saying that instead of going over to do all these things to get this, you can actually separate it and treat your 0.4 to the 4 million and go ahead with your deferred tax. It's as simple as that. So ladies and gentlemen, these are how you deal with deferred taxes. All right. Thank you very much, and enjoy the rest of the remaining videos you have on this YouTube platform where I serve you right. Have a great day.